It's an absolute delight to have in Nilesh Shah, MD and CEO of Envision Capital, joining us on the show. I got confused earlier when I mentioned that Nilesh Shah of Kotak AMC is joining in. So Nilesh Shah, Envision, excuse me for that, but you know it's a pleasure to have you always. Thanks for taking the time out today.
Thank you, Neeraj. Thank you so much.
So Nilesh, there's a lot of talk around how there are telltale signs which point to market exuberance and therefore there being a possibility of a very large gash in the markets. You would have heard of many of these and probably more. I'm wondering if you are concerned about valuations and a possible downtick, or do you believe growth will take care of the valuations?
Yes, so Neeraj, clearly it looks like that over the last few weeks, or maybe over the last couple of months, the markets seem to have moved on to a bit of a risk-off kind of mode. Especially with concerns around the kind of up move that we have seen in the mid and the small cap segment of the market. The broader markets have been a lot more weaker. But what I believe is that you clearly seeing that a lot of the froth which was there is out of the way. A lot of stocks have corrected by 20 to 25% from the recent highs. And our view is that if growth sustains, then it takes care of the valuation. As long as we have growth, we have premium growth, then valuations become less of a concern because equity markets is all about buying into growth. Clearly believe that the next financial year as well is likely to be a strong year for the economy and for our GDP and therefore growth for corporate India. So clearly believe that post this recent correction, the markets now seem to be relatively well balanced, if I may kind of use that word, and probably we might see some bit of time-wise consolidation. But I clearly believe that post a few weeks from now, we will be back on the upward trajectory.
Nilesh, hi, it's Samina as well joining, and I'm of course talking to you after a number of years. But nevertheless, what is your stand in terms of your portfolio? How much cash are you currently sitting on? Are you aggressively allocating? Are you looking at lump sum allocations on big falls? Is it more SIP? And I'm assuming it could be STP largely because you think there is a time-bound correction around the corner.
So we're not sitting on any significant cash. We probably have about 5 to 10% cash levels on an average in individual portfolios. Maybe for some of the more recent investors' portfolios in the last few months, maybe the cash levels are tad higher than the single digit. So we honestly don't take too much of cash calls, especially when it's on, unless we are yet in the process of building a portfolio. So those are the kind of situations where we would have cash, but otherwise, we clearly believe that the markets have become relatively attractive versus where they were a couple of months back, or maybe where they were at the end of last calendar year. So clearly continue to be very constructive, see several opportunities in the broader market. And the fact that we are seeing a very broad-based economic growth, that's translating into broad-based opportunities in the broader market. So that's essentially what our view and our stance is.
Also, the bigger sort of returns over the last year or plus has come in from the broader markets, and no one can deny the fact that that is probably the most tempting space to be in. But for the last few months, we've been consistently talking about how large cap should be, carrying the baton going ahead. Do you feel if an individual or an investor should be looking at rebalancing his portfolio? And if he does rebalance his portfolio, should the bias now shift to large cap stocks?
So, I probably think that would hold out for the short term. If you're really taking maybe a 3-month view or a 6-month view, that can still play out. There could be a bit of tiredness or fatigue in the mid and small cap space, because of which, they may not deliver the kind of relative outperformance over the next 3 to 6 months. And in that eventuality, the large caps may outperform for the very short term. But the bottom line is that large caps as a basket, especially if I were to kind of really look at the large cap IT services companies or the large cap FMCG companies, unlikely that they will be able to grow at a rate which is more than single digits. So clearly believes that ultimately it's going to be more about growth. And I believe that the broader segment of the market or the mid to small caps will be displaying or exhibiting much stronger and higher growth versus their peers in the large cap space. So yes, for the next 3 to 6 months, or maybe for the very short term, large caps can outperform, and as long as we believe in a kind of a quasi risk off mode. But once we've seen price-wise consolidation, if there's some bit of time-wise consolidation, it's quite possible that the broader market will kind of get back into its trajectory of outperformance.
Okay, Nilesh, the other aspect is just before we dwell into specific pockets, but before the break, one aspect is the macro situation. Are you constructive on macros? A lot of talk around CAD and coming off and the resultant impact on the currency and what it could do for stability, so on and so forth. Any thoughts here?
So, Neeraj, macros have never been as good. In the past, we've had situations where the economy has grown at 7 to 8%, but that's kind of led to higher inflation. Clearly believe that the macros continue to be extremely robust. Macros are benign. I think the government has taken essentially a very well balanced approach of having relatively high growth with an eye on inflation. So to that extent, I think it's a great situation to be in. Most of the big institutions or economists are still kind of upping their estimates of forecasts for economic growth, and I would tend to concur with that. So we seem to be in a period of maybe about 7 to 8% growth, and about maybe around 5% of inflation. And I don't see a cause of concern for that. In fact, that's a great situation to be in. We seem to be the standout nation, the standout economy from a global context. Second is again on the currency, and I would actually believe that yes, currently there is still that inflation differential of about 2% between the targeted inflation rates between India and the US. And so to that extent, you could basically see the depreciation of the currency to that extent. But over the medium to long term, I wouldn't be surprised that with the initiatives on localization, indigenization, import substitution, the huge focus on manufacturing, all of these factors are going to probably lead to at least a more measured depreciation, and who knows, maybe an appreciation of the Indian currency. In addition to that, of course, flows coming in from FPIs, flows into bonds. These are all the kind of developments which at least will lead to a relatively benign scenario on the currency side, which will have a positive spin-off effect on imports and inflation. In addition to that, of course, this whole drive towards energy security is probably for the first time we are seeing it. And I believe that that itself is going to be a significant game changer for India, maybe for the rest of this decade. So I think on the whole, India's macros are great. India's macros are very compelling. And that in turn is likely to result into a fantastic investment climate.
Nilesh, a question that comes to mind is what will benefit going ahead? We are at the cusp of an earnings season. We're looking at possibly some earning revisions on the downside after the pace of earnings growth that we've seen in the last 2-3 years. Where is it that Nilesh Shah is most constructive on?
So clearly from a very longer term perspective, Neeraj, clearly believe that there are three very, very strong phenomena which are expected to play out. First, of course, is the whole journey towards digitalization. So to that extent, if I may use the word, that India is basically transiting towards a digital economy. And therefore, this is likely to be India's decade. So that's one big kind of theme, and therefore one very large kind of pocket of opportunity. The second is been our traditional stronghold, which is the consumer economy, and there are phenomena like higher penetration and then premiumization as well, are the kind of twin forces which are driving the consumer economy, aided by support coming in from the digital economy and an aspirational India. The third big opportunity is around the physical economy, and this typically would entail the energy security, which I was alluding to earlier, and the whole shift towards renewables. and decarbonization. The second is manufacturing with a drive to have import substitution, localization, and eventually exports. And third, of course, is the whole infrastructure built up, the public sector capex, the private sector capex. So I'd broadly say that the opportunities are going to be around the digital economy, the consumer economy, and the physical economy. These three are essentially going to be the big sources of opportunities from an investment perspective.
Nilesh, while bulls aren't yet ready to give up on the potential of PSU bank stocks given the earnings turnaround, the case of the underdogs are getting louder, at least at a valuation level of PSU banks, as they, of course, trade at historical highs, while private banks are the ones that are languishing near decade-long lows. Where do you think the trade is? It's a tale of two opposites. Which one are you betting on?
Well, for now, I probably believe the trade is more skewed in favor of private banks. The private banks are emerging out of a long period of stagnation from a stock price performance or a relative performance as well. It's probably been maybe 3 years of underperformance, and still believe that going forward, the private sector banks will continue to sustain a double-digit growth rate, on the balance sheet side, especially on the loan side. Yes, there could be a bit of challenges on the NIMs, but I guess the franchises are very strong enough to be able to navigate through that. Versus that, the PSU banks, probably a lot of the capitalization and the balance sheet strengthening is kind of factored into their stock prices. So I probably believe that the private sector banks have a better chance of outperformance. The only caveat here being that post the general elections, if there is a privatization initiative, and one or two banks have been lined up for privatization, that's at least been the intent and the policy announcement. If that materializes into action, that could lead to the next round of re-rating for PSU banks. But otherwise, purely on a very steady state standalone basis, I probably think that for the short to medium term, it's very likely that the private sector peer group will outperform their public sector peer group.
Okay. The other thing, like Nilesh, like the UBS note today, for example, right, talks about a very expensive capital goods stock and says that the margin uptake and the earnings uptake will make sure that the premiumness and valuation stays. How to best play the Capex theme now? Because the Capex which will unfold over the next 5 is arguably going to be very different from what happened in 2003, 2008, right? So how to best play the upcoming Capex cycle?
So clearly continue to be very positive on the Capex cycle, but it's quite possible that going forward, the private sector or the Capex play led by the private sector will essentially at least be as good or will do a catch up with the public sector Capex. So I probably believe that actually the Capex oriented opportunities will only expand. Traditionally, at least over the last 1 or 2 years, we've really seen the the government take the lead. And therefore, it has been pockets like railways and defense, which have done extremely well. But going forward, clearly believe that it's going to be a lot more broad-based. I earlier alluded to the energy side and the kind of investments which are happening on the energy side. So clearly believe that companies or businesses which are a proxy for the huge investments which are expected in renewables, and this whole drive towards decarbonization will essentially probably take the lead or at least be a pocket of strong outperformance versus rest of the pack. The rest of the pack will essentially do well. We've seen some bit of price correction in terms of their stocks. It's quite possible that maybe they would probably consolidate for maybe a quarter or two before the markets get again confident about their higher growth trajectory. Once there is evidence of that, I expect even the rest of the Capex pack to basically catch up. So I think across the board, be it railways, be it defense, or be it energy, or some of the other private sector-led Capex, clearly believe that it's going to be, again, a basket of opportunities out there.
Nilesh, you are probably the best voice on the IT sector. Tell us what you think about this space. The last 10 years, this is one sector which has been the best performing sector. It's done double-digit returns. But the fact remains business is slowing down. There were days when you'd see the rupee move weaker and IT stocks would actually react positively. I know, very naive in that sense. But even those sort of trades have now become history, right? With the changing landscape, AI, digitization, cloud, politics in the US, how does one approach the IT pack? Is it time to go overweight, or is there still some time to go before an investor can make such calls?
So there are surely headwinds for the large cap IT sector and IT services. There are clearly headwinds out there. Even over the last decade or so, these are companies which probably have grown at best 10% in terms of their revenues or their earnings. Maybe the earnings might have been a tad higher. But I probably think the revenue growth, especially on the organic side, has been single digit. And I don't think over the next decade or so, or over the next 5 years or so, I don't see the growth rates for the large cap IT services companies to kind of trend higher. Probably the best case situation would still be single digit growth rate. And I don't think you should be in equities for a business growing only at single digits. So probably believe that the large cap IT services companies will at best be kind of short-term trading opportunities or short-term investment opportunities, where you probably buy them when there's a sell-off and then you kind of play for that mean reversion. However, with the caveat, of course, that if any one of them announces something really big on the generative AI side, then that's obviously a very, very different kind of a development. But otherwise, clearly the opportunity in the Indian IT services side continues to be very bottom up, continues to be more around the tier 2, tier 3 names, or maybe the mid to small cap companies, where given the limited size, they probably be more fleet-footed to get incremental business and deliver cost-efficient solutions to their enterprises, their enterprise customers. And these could be companies which are focused around engineering, R&D services, software-defined vehicles, mobility, a whole bunch of opportunities, including, of course, implementing AI. So I probably believe that the bias would be, or the preference would be, for the tier 2, tier 3 IT services companies, which are very specialized and are going to be a lot more fleet-footed versus the large cap peers.
Nilesh, very lastly, for the next 1 to 2 years, your top sector to bet on. From the larger sectors, give me one sector, and from the smaller ones, maybe like an insurance, anything that you like, a diagnostic play, because those are two teams that have been, ruling the headlines in the last 24 hours. But two sectors, one big one and one small one, where you're seeing value and one can buy.
So clearly believe, the whole drive towards digital India, India's decade, and the fact that we are having a huge formalization and financialization of the economy. So clearly the online fintech segment continues to be a very, very kind of an attractive opportunity. Clearly, be it online broking platform, be it an online insurance platform or an online credit platform, clearly that's a great opportunity to be in. Or it could even be a very normal home lender, but using technology to kind of deliver loans in the affordable housing segment. So that, I think, as a pack, continues to be very great. So I'd probably say that the online financial or the fintech space continues to be very attractive from an investment point of view. And the second would be around the premium consumption side. Still believe that there's a huge opportunity for premium consumption, and that would probably be the second area of preference.
Okay. Nilesh, such a pleasure talking to you. Thanks for taking the time out and being with us today, and look forward to seeing you in the studio soon.
Thank you. Thank you, Neeraj and Samina. Always a pleasure.
Thank you.